Welcome back to Northern California Living. I am Amanda Abillano, your East Bay and Contra Costa County real estate reference. And today we're going to be continuing our How to Buy a California Home video series. And this is video 3, and we are going to be covering one of the most important steps. And that step is talking to a lender, and they are going to help you find out how much you're approved for and what type of loan will fit your situation. A lot of people think that this step is a very quick step, but the truth is that it is not, because you are going to find out this conversation is going to set up your budget, your timeline, and even how strong of an offer you'll be able to offer on your home when you go to write for one. So let's break this down into steps that are simple and clear and very specific to what you'll experience when you are going to talk to a lender right here in California. So why is talking to a lender early, why does that matter? So before you step into an open house, you need to understand your buying power. Talking to a lender is going to help you answer, what price range can I realistically shop in? What will my monthly payment be? What loan programs do I qualify for? How much money do I need to save? What financial issues do I need to fix before buying? Here in California, home prices vary from city by city to county by county. So your lender determines on everything on how you approach your search. So when you are talking to a lender, they are going to evaluate based on the 4 pillars, and that is your income, your credit score, your debts to income ratio, your DTI, and your savings and assets. So let's talk about the first pillar, which is your income. They are going to look at salary or hourly income, overtime, bonuses, commission, self-employment income, side income, sometimes a 1099 or contract work. In California, where the buyers are a lot in tech and healthcare and hospitality or even gig-based work, lenders have specific guidelines for documenting everybody's income. So the second pillar is your credit score. Your score impacts your interest rate, your loan type, your monthly payment, your required down payment for some loans. A difference of even 20 points can shift your approval amount dramatically. Your third pillar, which is your debt to income ratio, that includes car payments, credit cards, student loans, personal loans, alimony and child support, and minimum monthly payments. So lenders do use your DTI to calculate how much monthly mortgage payment you can afford on paper. So California lenders often allow slightly higher DTI ratios because of the cost of living, but they still have strict limits. Now, the last pillar is your savings and assets. And they'll ask about checking and savings accounts, retirement accounts, gifts from family, stocks or investments, and cash reserves. So these 4 pillars are going to help you determine your down payment, your closing costs, whether you qualify for a certain loan type, and your overall financial strength. The more organized you are with these documents, the easier the process becomes. So jumping into documents and what you're going to need. The lender will typically ask for the following. For employed buyers, they're going to ask for 30 days of pay stubs, last 2 years of W-2s, last 2 years of tax returns sometimes, 2 months of bank statements, a photo ID, and for self-employed buyers, you're going to need last 2 years of full tax return, profit and loss statement, depending on the lender, business bank statements, 1099s, 2-month statements of your own bank account, and a photo ID. And for everyone, you're going to have credit check, a list of debts, and permission to verify employment. It may seem like a lot, but California lenders are used to handling every type of income scenario, from contractors to truck drivers to tech workers, so don't be nervous. So let's talk about how your approval amount is calculated. Your approval is based on your income, how much you make monthly, your debts, what you already owe each month, your interest rate. Higher rates mean lower approval amount, taxes and insurance in the area that you buy. And in California, these vary widely, and loan type. So that can be VA, FHA, conventional, all calculate things very differently. So your lender will be taking all of that, and it determines your maximum monthly payment, and they convert that into a total home price. And loan types that you will learn during your call, possibly. Your lender will help you understand which loans you qualify for, but the main ones in California are FHA loans, which is a low down payment, 3.5%. It's got more flexible credit requirements, great for first-time buyers, and higher mortgage insurance, unfortunately. Conventional loans. So this down payment ranges from 3% to even 20% and up. These are better rates with higher credit, lower monthly mortgage insurance. VA loans. So this is for individuals who have served in the military. So you'll have 0% down, you'll have no mortgage insurance, and they are the best benefit for qualifying veterans. Now USDA loans, and these are only available in certain rural areas, and these are 0% down, and they have income limits that apply. And they're most applicable for outskirts or farmland communities, not typically inside the Bay Area suburbs, but you'll see it just a bit further out. CalHAFA loans, California program. California has several programs designed to help with down payment, closing costs, and affordable home ownership. So these programs change frequently, so your lender will explain which ones are currently active and why you should shop for different lenders. So one lender might give you a higher approval amount, a better interest rate, lower fees, different loan options, and it's completely okay. And I recommend to talk to two to three lenders. Multiple credit pulls with short window count as one inquiry for your mortgage payments. You're not being disloyal, you're being smart, and don't let them tell you that. And these are the things that your lender should be explaining to you. A good California lender will walk you through your max purchase price, your ideal purchase price, your estimated monthly payment, your closing cost estimate, how to structure your down payment, what loan programs fit your situation, what financial issues you should fix before shopping, how long your pre-approval lasts. You should never leave a lender meeting feeling confused or rushed. Now, the magical pre-approval letter. You need this to start shopping at homes. At the end of the lender conversation, you should receive a pre-approval letter after you have sent over your documents and everything like that, and they've ran your file through to get you a pre-approval letter. This is your golden ticket. It tells sellers that you're financially qualified to buy their home. In California's competitive market, no agent or seller will take you seriously without it. You're gonna be using this letter for open houses, private showings, writing offers, negotiating, and escrow. And your agent will likely update this letter for each offer to match the price that you are offering on the house. Thank you for joining me in part 3 of this series. Now that we know your pre-approval amount is calculated and loan options that are available for you, we're ready for the next video. And in the next video, we're going to be breaking down each loan type in detail, which is the FHA, conventional, VA, USDA, and California programs. This next video is the big one because understanding your loan determines everything from your down payment to your closing costs to your monthly payment. If you found this helpful, make sure to tap like, subscribe, and comment below with your questions. And if you're planning to buy in Northern California, my contact info is always in the description. I'd love to help you get started. And thanks for watching Northern California Living, and I will see you in video 4.